Welcome back to Investing Talk Podcast.
Today we're looking at Illumina.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. I think for you, the key narrative surrounding Illumina right now is that the company's at a major financial inflection point.
A transition year, right? That's what management is calling it. They're trying to pivot the business model.
Exactly. And they're being very explicit about framing 2025 as this, critical pivot. They're trying to shift perception away from being just a research tool provider.
Which can be really cyclical, very dependent on capital expenditure.
Right. To focusing on, clinical genomics and this whole future of multiomics. And they're telling the market, look, 2026 and 2027 should look progressively better than 2025.
Basically saying, we're in the trough right now.
We're in the trough.
Yeah.
But you can see why there's some skepticism if you just look at the raw top-line numbers.
Oh, for sure. I mean, Q2 2025 revenue was actually down about 3% year over year. And the instrument segment was the real problem, down a steep 18%.
And that's the classic short-term headwind. When labs tighten their budgets, they delay buying those big, expensive machines.
Right.
But the crucial point here, and this is so important, is what held steady. The consumables revenue.
The razor blade part of the business?
Exactly. That high-margin recurring business held flat at $740 million. And that, to me, signals there's a real structural floor beneath everything.
And the Q3 data seems to support that bottoming out idea. Revenue was what, $1.08 billion?
It was. And while that's flat year over year, it actually beat the street's expectations.
So that suggests the rate of decline has stopped and we're maybe hitting that stabilization period they promised.
I think so. The full-year guidance kind of confirms it, too. They're pointing to flat or maybe slightly positive growth, 0 to 2% in constant currency.
Okay, so the top line is consolidating. But this is where the story gets really interesting, right? The earnings leverage.
This is the entire bullish pivot. They are proving they can pull out enormous profitability even with zero revenue growth.
So how are they doing that? What's the secret sauce there?
It's really a 1-2 punch of aggressive cost discipline and just the structural leverage they have. They are managing expenses so tightly.
I saw that in Q2. The non-GAAP operating margin expanded quite a bit.
It did, by 160 basis points to 23.8%.
And for anyone listening who isn't deep in financial metrics, 160 basis points just means the margin improved by 1.6 percentage points.
Right. And non-GAAP is key because it gives you a cleaner picture of the core business health. And that discipline just showed up in a huge way on the bottom line in Q3.
The EPS number, yeah, it came in at $1.34, which was way ahead of the consensus of $1.17.
That's the signal the market is reacting to. And it wasn't just on the operations side. Look at the gross margin.
A very healthy 66.6%. That points to pricing power, right? And control over their manufacturing costs.
For sure. They have demand for their consumables, which lets them keep those premium prices.
So this all allowed them to not just beat for the quarter, but to raise their full-year guidance pretty significantly.
Yeah, up to that $4.65 to $4.75 range. And if you look at the quantitative signals, analysts are now expecting 2025 earnings to soar something like 92.2% year over year.
Wait, I have to stop you there. Doubling earnings in a single year while revenue is flat. That just tells you how extreme the leverage is in this model.
It's the definition of a bullish pivot. The market is buying into a sustainable multi-year trend of earnings growth, not just a one-off.
So the immediate story is all about the financials, but none of that leverage would even exist without their competitive moat.
Absolutely. The moat is everything. And it's built on, really, 2 pillars: scale and switching costs.
And the NovaSeq X platform has to be the centerpiece of that scale story.
It is. In Q2 2025 alone, they placed over 50 of those instruments. I mean, these are massive high-throughput machines that become instant anchors in labs.
And the adoption rate is so critical. That platform is already driving a huge chunk of recurring revenue.
It's already at 44% of their high-throughput consumables revenue. And their target is to hit 50% by the end of this year.
That 44% number is just wild. It means nearly half of their biggest, highest volume customers are already locked into the latest generation of hardware.
And that guarantees years of high-margin consumables revenue. But you can't forget the other end of the market, the smaller labs.
You're talking about the MESEC I100 Plus.
Exactly. It surpassed 500 placements. And its real power is that it supports 18 proven end-to-end workflows.
So if you're a university lab, the cost of switching isn't just financial, it's operational agony. You'd have to change all your protocols.
That's how they make it sticky, exponentially sticky.
Beyond just the installed base, though, They're clearly pushing hard on the next wave of technology. I keep hearing them talk about genomic AI.
That's the next layer of the moat. When you have the most machines generating the most data, you're in the best position to use AI to interpret that data.
Turning a data advantage into a deep learning advantage.
Right. And you can see that with their 5-base solution. It sounds super technical, but it's a huge deal.
So what's the significance of reading 5 bases instead of the usual 4?
It lets them read both genomic and epigenomic information at the same time. Think of it like this. Traditional sequencing reads the DNA, the blueprint.
Okay.
Epigenetics reads the annotations on the blueprint. It tells you how and when genes are expressed. That's critical for understanding things like cancer and aging.
So by offering a single platform for DNA, RNA, and now epigenetics, they're putting themselves right at the forefront of what people call multiomics sequencing. You get the whole picture.
And this isn't just them saying it. A recent Nature study validated their whole genome sequencing for providing better insight into common diseases.
And that external validation is gold for clinical adoption. Doctors and regulators trust peer-reviewed science.
Which brings us right to the clinical pivot. Clinical applications now make up about 60% of their sequencing consumables.
And that's a huge deal for the business model because it creates these regulatory-backed switching barriers.
It's massive. If a diagnostic lab gets a test approved using their platform, changing it means revalidating the entire regulatory process.
Which is incredibly expensive and takes forever. So that revenue is far stickier than, say, a research grant.
Exactly. The business becomes embedded in the healthcare infrastructure itself.
Okay, let's talk about how they're trying to speed this up with M&A. I'm talking about the SomaLogic acquisition.
Right. This is about adding the third pillar. Illumina already dominates DNA and epigenetics. To really deliver on multiomics, they needed a strong proteomics capability.
And proteomics is the study of proteins, which are the functional workhorses of the cell.
Correct. So they bought SomaLogic for $350 million in cash, plus some potential milestones.
Oh.
The goal is to integrate SomaLogic's tech to create a single platform for DNA, epigenetics, and proteins.
Strategically, it makes perfect sense. They want to be the one-stop shop. But this is where I start to worry about execution risk.
It's a fair concern.
They're projecting SomaLogic won't even be profitable until 2027, and its margins won't align with the core business until 2028. That is a very long road.
It is the key challenge.
Mm.
It requires flawless execution for the next 3 to 4 years. You are absolutely right to flag that.
If the whole story is that they're emerging from a trough now, couldn't this long, expensive integration project slow down the turnaround?
I think the mitigating factor is their financial scale. The initial $350 million cash outlay is pretty modest for their balance sheet.
Right.
The risk is more about management focus.
But the prize is huge if they pull it off.
It is. If they deliver the only truly integrated, scaled multiomics platform, they could lock up the next decade of growth in clinical sequencing.
And we are seeing some early signs of traction in proteomics already.
We are. The Illumina protein prep product has already been adopted by over 40 customers, which shows there's real demand for this integrated solution.
So let's not get too carried away. We have to talk about the bear case. The number one risk has to be that top-line stagnation just drags on longer than expected.
And the instrument segment is still the main drag there. It's guided down 4 to 6% for the full year.
And that's because of macro pressure and those export restrictions in China, right?
It's those two factors, primarily. So you have the instrument weakness risk and then the execution risk we just talked about with SomaLogic.
Right. If that integration stumbles, the market will punish them.
That's fair. But you have to put it in context of the stock price. It's already de-rated significantly. It's still well below its 52-week high of over $156.
So a lot of that risk might already be priced in.
I think so. And the strategic shift toward recurring consumables driven by the NovaSeq X limits the long-term impact of that cyclical instrument weakness. They're changing the financial center of gravity of the company.
That's the ultimate risk mitigator. The business just becomes more resilient over time.
Exactly.
Okay, let's look at the technicals because the market's reaction to those Q3 results was pretty powerful.
It was explosive. After the EPS beat and raised guidance, the stock surged about 24.5% in a single day, October 31st.
A move like that signals a huge trend inflection. It tells you institutional money is jumping back in.
It does. It suggests the stock is moving out of what we call a long basing pattern, that sideways consolidation, into a new uptrend driven by fundamentals.
So for investors watching this, what are the key technical levels to keep an eye on?
Well, the first critical support level is that post-gap low, right around $95. A healthy pullback should hold there.
And below that.
The whole prior consolidation zone in the high 80s to low 90s is a much deeper support area. As long as it stays above those levels, the new bullish structure is intact.
And we have a few catalysts coming up on the calendar to watch.
The main event is the next earnings release for Q4 and the full year, probably late January or early February.
And the market's going to zero in on two things there, confirming they hit the 2025 EPS range and the initial guidance for 2026.
Right. They need to show that revenue reacceleration is really on the menu for next year. There's also an upcoming investor conference webcast, which is a chance for them to update on Novasec adoption.
And I saw they're participating in the China International Import Expo.
Which is important. It shows they're not abandoning that market despite the headwinds.
So to sum it all up, the final thesis is that while 2025 might be the revenue trough, it's also the peak for operational efficiency. They're delivering accelerating EPS growth.
All while leveraging their dominant platform to capture the future of genomics.
So the long-term opportunity is that they control the entire sequencing ecosystem, and they're using that control to extend their moat into this full multi-omic picture.
The story is really about owning the platform for a multi-year upswing. They're emerging from this consolidation phase healthier and more profitable than they went in.
The real power here is that they're transitioning from selling just hardware to selling integrated biological truth. That's what locks customers in.
Exactly, and that shift is translating directly into higher earnings per share right now.
Well, that wraps up our analysis on Illumina. If you enjoyed this, make sure to subscribe, like, and comment to stay informed on our next exploration of the markets.